Understanding economic bubbles and crashes. Introduction. Economic bubbles and crashes are phenomena that have shaped the course of global economies throughout history. These events are often characterized by rapid and unsustainable increase in asset prices, followed by an equally rapid collapse. The consequences of economic bubbles and crashes can be devastating, leading to significant financial losses, widespread unemployment, and economic recessions. However, understanding the underlying causes of these phenomena and how they unfold can help prevent or mitigate their impact. This article will explore the nature of economic bubbles and crashes, their causes, historical examples, and the lessons they provide for future economic stability. Defining economic bubbles. An economic bubble refers to a situation where the price of assets, such as stocks, real estate, or commodities, rise significantly above their intrinsic value. The increase in prices is usually driven by speculative behavior, where investors purchase assets not based on their fundamental value, but on the belief that prices will continue to rise in the future. These bubbles often lead to an overvaluation of assets, creating an unsustainable economic situation. This section will define what constitutes an economic bubble, focusing on the characteristics of asset price inflation and the factors that contribute to the formation of a bubble. Causes of economic bubbles. Several factors contribute to the creation of economic bubbles, and often a combination of them leads to their formation. Some of the primary causes include speculation. When investors buy assets based on the belief that price will keep rising, they may create a speculative bubble. Speculators often drive prices higher without regard for the true value of the asset. Excessive credit. When financial institutions offer easy credit and low interest rates, individuals and companies can borrow more money than they can afford to repay. This influx of credit can push asset prices to unsustainable levels. Herd behavior. Investors often follow the actions of others, especially during periods of economic optimism. This herd behavior can lead to an overvaluation of assets as individuals jump on the bandwagon hoping to profit from rising prices. This section will discuss the various causes behind the creation of economic bubbles, including psychological factors, market dynamics, and external economic influences. Characteristics of an economic bubble. Economic bubbles have certain defining characteristics that can help identify them. These include rapid price increase. The most obvious sign of a bubble is the sharp, rapid increase in asset prices, often driven by speculation rather than underlying economic fundamentals. Overvaluation. During a bubble, the price of an asset significantly exceeds its intrinsic value, which is often based on factors like earnings, growth potential, and market demand. Widespread euphoria. Bubbles are typically accompanied by a sense of excitement and optimism in the market, where investors believe that the good times will continue indefinitely. This section will examine the key characteristics of an economic bubble and explain how these features distinguish a bubble from more stable, sustainable price growth. The role of speculation in economic bubbles. Speculation plays a central role in the formation of economic bubbles. Investors often buy assets with the expectation of selling them at higher prices in the future. This speculative activity drives up demand for the asset, which in turn increases its price. As more people become involved, the prices continue to rise, creating a feedback loop that more people become involved. As more people become involved, the prices continue to rise, creating a feedback loop that reinforces the bubble. However, when the speculative interest wanes or market sentiment changes, the bubble bursts, leading to a sharp decline in asset prices. This section will explore the role of speculation in economic bubbles, discussing how the psychology of investors drives the inflation of asset prices and contributes to bubble formation. The process of a bubble's collapse. Once an economic bubble reaches its peak, the inevitable correction often follows. The collapse of a bubble typically happens quickly and can be triggered by various factors, such as market sentiment shifts, When investors begin to realize that prices are unsustainable, panic selling may occur, leading to a sharp drop in prices. External shocks. Economic events such as changes in government policy, rising interest rates, or geopolitical instability can trigger the collapse of a bubble, diminishing demand. As asset prices fall, demand for the asset decreases, and the market experiences a downward spiral, leading to a crash. This section will examine the process of a bubble's collapse, explaining how the factors that contributed to the rise of the bubble can quickly reverse, causing prices to plummet. Historical examples of economic bubbles. Throughout history, there have been numerous examples of economic bubbles that have had profound consequences on the global economy. Some of the most notable include the Tulip Mania, 1637. Considered one of the first recorded economic bubbles, the Tulip Mania in the Netherlands saw the price of tulip bulbs skyrocket before crashing, causing widespread financial losses. The South Sea Bubble, 1720. This was a speculative bubble in the United Kingdom centered around the South Sea Company, which promised vast profits from trade with the Americas. The bubble burst, leading to a financial collapse. The Dotcom Bubble, 2000. The rise of internet-based companies in the late 1990s led to a rapid increase in stock prices for tech firms, many of which had little to no profit. The subsequent crash in 2000 resulted in a major loss of wealth and economic disruption. The 2008 global financial crisis, the housing bubble in the United States, fueled by subprime mortgage lending and excessive borrowing, led to a collapse in property prices, causing a global financial crisis. This section will provide a detailed analysis of several historical economic bubbles, discussing the factors that led to their formation, the events that caused their collapse, and the economic consequences that followed. The impact of economic bubbles on the global economy. The impact of economic bubbles and their subsequent crashes can be catastrophic. When a bubble bursts, often leads to financial crises, bankruptcies, job losses, and severe economic recessions. The effects are felt across the global economy, especially if the bubble involved widely traded assets such as real estate, stocks, or commodities. Governments and central banks often respond by implementing fiscal and monetary policies to stabilize the economy and prevent further damage. This section will analyze the broader impact of economic bubbles on the global economy, discussing the ripple effects that can cause widespread financial instability and lead to long-term economic recessions. The role of central banks in managing bubbles. Central banks play a critical role in monitoring and managing economic bubbles. By adjusting interest rates and regulating the money supply, central banks can influence the credit environment and attempt to prevent excessive borrowing and speculation. However, identifying and addressing bubbles before they burst can be challenging, as bubbles are often driven by factors that are difficult to predict. Central banks must carefully balance the need to foster economic growth with the need to prevent financial instability. This section will explore the role of central banks in managing economic bubbles, focusing on their policies, tools, and strategies for controlling credit and preventing asset price inflation. Government regulation and its role in preventing bubbles. Governments play an essential role in regulating financial markets to prevent the formation of economic bubbles. By implementing laws and regulations that promote transparency, protect investors, and reduce the risk of speculative behavior, governments can help prevent bubbles from forming. Regulatory bodies, such as securities commissions and financial watchdogs, are responsible for overseeing financial markets and ensuring that investors have access to accurate information. Proper regulation can help mitigate the risks associated with bubbles and crashes. This section will discuss the role of government regulation in preventing economic bubbles, examining the importance of transparency, accountability, and oversight in financial markets. Lessons learned from past bubbles. The history of economic bubbles provides valuable lessons for policymakers, investors, and financial institutions. By studying past bubbles and their causes, can gain insights into the conditions that lead to unsustainable asset price increase and better understand how to identify and address bubbles before they collapse. Some key lessons include the dangers of speculation. Excessive speculation can lead to inflated asset prices and create a false sense of security in the market. The importance of risk management. Investors and financial institutions must manage risk and avoid over-leveraging, especially during periods of market exuberance. The need for a strong regulation. Governments must implement effective regulations to protect markets from excessive speculation and ensure financial stability. This section will reflect on the lessons learned from past bubbles, focusing on the strategies that can be employed to prevent similar crises in the future. Psychological factors and the formation of bubbles. Psychological factors such as greed, fear of missing out, and herd mentality play a significant role in the formation of economic bubbles. Investors often become irrationally exuberant during periods of rising asset prices, believing that the trend will continue indefinitely. This collective optimism can drive asset prices to unsustainable levels, creating the conditions for a bubble to form. When market sentiment shifts, fear and panic can cause a rapid collapse, exacerbating the effects of the crash. This section will explore the psychological factors that contribute to the formation of economic bubbles, focusing on how emotions and social influences shape market behavior. The role of technology in amplifying bubbles. Advancements in technology, particularly in financial markets, have made it easier for investors to participate in speculative activities. Online trading platforms, social media, and algorithmic trading have all contributed to the rapid spread of information and the amplification of bubbles. In some cases, technology can accelerate the growth of a bubble, enabling more participants to engage in speculative trading. However, technology also plays a role in the rapid dissemination of news during a market crash, amplifying the panic and driving down asset prices even faster. This section will examine the role of technology in amplifying economic bubbles, discussing how innovations in finance and communication can speed up the formation and collapse of bubbles. Preventing future bubbles, policy recommendations. Preventing future economic bubbles requires a combination of prudent economic policies, regulatory measures, and investor education. Policymakers must be proactive in monitoring asset markets, identifying potential bubbles early, and taking action to prevent excessive speculation. Financial institutions should also adopt risk management strategies that protect against the potential fallout from market fluctuations. Educating investors about the risks of speculation and encouraging long-term value-based investing can help mitigate the likelihood of future bubbles. This section will provide policy recommendations for preventing future economic bubbles, focusing on proactive measures, regulation, and investor awareness. Conclusion: economic bubbles and crashes are an inherent part of market cycle. While they can result in significant financial hardship and economic instability, they also offer valuable lessons for understanding market dynamics and improving economic system. By studying past bubbles and implementing effective policies, governments, central banks, and investors can work together to prevent future bubbles and minimize their impact. As markets evolve, the need for vigilance, regulation, and responsible investment will remain crucial in maintaining economic stability and fostering long-term growth. Conclusion: understanding economic bubbles and crashes is essential for anyone involved in finance or economics. By analyzing the causes, characteristics, and impacts of these events, we can better prepare for and potentially avoid future financial crises. By adopting strong regulatory frameworks, improving market transparency, and managing speculative behavior, we can reduce the risk of bubbles and crashes, ensuring more sustainable economic growth for the future.